Good morning, traders. It's Dee, and we're here today to give you the latest news so we can have a successful trading day. So what do we need to know today about the trading session ahead? Well, first off, Wall Street fell ahead of Federal Reserve Chair Jerome Powell's speech at Jackson Hole, Wyoming, which takes place today. This is perhaps the biggest news we need to pay attention to. The S&P 500 yesterday dropped 0.8% after coming within striking distance of its all-time high. The Dow Jones Industrial Average slid 0.43%, and the NASDAQ Composite lost 1.67%. All three indices had traded higher during the session. At the end of the news, we're going to go over our charts from yesterday, and I want to talk about what clues we could have seen in our charts that would have kept us on the right side of the market, in spite of the fact that so many things look bullish at the beginning of the day. So we'll go over that in a few minutes. But the bottom line is today is the day Jerome Powell speaks at Jackson Hole. Today, he's going to deliver one of the most anticipated economic speeches of the year. With the vast majority of Fed members advocating for a rate cut in September, markets are banking on a 100 basis point reduction for 2024. The expectation suggests at least one 50 basis point cut, given that there are only 3 rate-setting meetings left for the entire year. A lot of his speech today will focus on the risks of being too aggressive with rate cuts versus being too late to cut rates. And I think his comments will really focus in on trying to find that middle ground, which helps maintain or safeguard the economic expansion while ensuring inflation remains contained. Henry Allen of the Deutsche Bank thinks that the market rate cut forecasts for the next year are overly dovish given the current state of the economy, and markets are pricing in 200 basis points of cuts in the next year alone. And those are the sort of paces you only normally see during a recession, not in a non-recession. Despite this, the Fed has faced criticism for keeping rates too high for too long, with some arguing that its heavy reliance on data could negatively impact the economy and the stock market. A soft landing, the probabilities are going up, and that's why this should be a benign cutting cycle, and would be good for markets. But I think the key is the Fed getting off the data dependence, because data dependence is the reason they missed the inflation turn. In Treasury news today, the U.S. 10-year Treasury fell slightly on Friday as investors waited the remarks from Jerome Powell. At 4:08 a.m. Eastern Time, the yield on the 10-year Treasury was down under a basis point to 3.85, and the yield on the 2-year Treasury rose under a basis point to 4.01. It's important for us as day traders to know that yields and prices move in opposite directions, and 1 basis point equals 0.01%. In NVIDIA news, NVIDIA reversed lower after analysts at Citibank gave it a price target of $150 a share while holding a buy rating. Analysts also see the stock hitting a new high after its second quarter results are announced next week. They also expect a strong outlook for its newest AI chip, Blackwell. But while NVIDIA and other tech stocks were sold off amid economic worries that hit the whole market earlier this month, they have yet to fully retrace their losses. Some have called time on the tech outperformance, but the last 2 years have shown it's crazy to wager against NVIDIA. Sure, NVIDIA's tech giant clients may slow down AI spending at some point, and worries about delays for its next generation chips can't be totally discarded. But while rate cut timing will remain up in the air for a while yet, investors can count on something special happening with NVIDIA. In Asian markets, they're mixed. The yen is up. The yen gained 0.3% to 145.77 against the US dollar, as the Bank of Japan's governor said he would press ahead with raising interest rates, but warned markets remain unstable. Japan's Nikkei 225 rose 0.4% as core inflation accelerated for the third straight month, and Hong Kong's Hang Seng Index fell 0.44%, while mainland China's CSI 300 climbed 0.28%. Alibaba Group edged up 0.55% after the Chinese tech giant said it would convert its secondary listing in Hong Kong to a primary listing, a move that could attract new funds from the mainland. In South Korea, the Kospi and Australia's S&P 200 were little changed. In terms of gold prices surged to a new record high, reaching $2,531.60 per ounce on Tuesday. The precious metal is up 20% year to date, outperforming the S&P 500, and analysts predict further gains, driving gold mining stocks higher. So now let's go to our charts and talk about what we see from the market profile and how the market profile charts could have helped us yesterday in terms of our trading. So as you can see, this big volume node right here I was noticing that before the market opened because we opened with a slight gap. And as we know, gaps usually signal very, very bullish. So I'm wondering if any of us got caught on the wrong side of this trade yesterday. But I want to show you things that could have given you caution and things that could have kept you on the right side of the trade. So as Jim Dalton says, we trade value, not price. The value area is this blue square here, and these blue squares here. And as you can see, if we look back a couple days, value area on 8/19 was down here. We had this little breakout of balance. And then you can see on the 20th, value was clearly higher. It wasn't even overlapping, clearly higher. Then on the 21st, it continued its move up. But as you can see, that value area is closer together and they're becoming more condensed. And the ranges for the day were also becoming more rotational. So coming into yesterday, we had the signal of the gap up, and I'm going to have Charles come in and talk to us in a few minutes about how he sees this also. But I saw this big volume node. That's usually I mark these high volume nodes on my chart because it shows us areas where the market is likely to consolidate or perhaps turn around. So we filled the gap, and I'm on the NASDAQ, just so those of you aren't confused with the ES. This is the NASDAQ chart. We started to move higher, and I did get confused because it broke this volume node rather easily. And I thought, okay, that's really, really bullish. But then it became a look above and fail. How would we have known that? And the other thing that Jim Dalton teaches is when you have a look above and fail of the day, the overnight high, usually the target of your trade is to the opposite side of the day, which, as you can see, was exactly what happened. It went back into the overnight. It spent time and brought in volume. These pink areas here where the volume is really high and a lot of time was spent. So this was the first clue that it's spending time and bringing volume inside the overnight range. So that would have been the first clue. Let's not go long. Let's wait and see what happens. And then it re-entered the previous day's range. Here's the previous day's high right here. And it came all the way down to where the overnight spent most of its time. And it brought in time and volume. And now you're deeply in the overnight range and you're inside of yesterday's range. So at that point, you also had the clue of this first set of single prints. So I mark my single prints with the top of the single prints and the bottom of the single prints, and I call this SP1 because this is the first set of single prints. So now you have a set of single prints signaling to you while you're re-entering these two ranges that the momentum is definitely to the downside. And then as you can see, once it broke that overnight low, there was a pretty big sell-off, and we got our second set of single prints here. And then once we broke that regular trading session hour low, which we're actually about to re-enter right now in the overnight range, you can see that the market sold off for the rest of the day. So Charles, what are your opinions about the idea of not getting too caught up in all the hype that the market's going up to the new high, the market's so bullish, we opened with a gap, but the market sold off intensely. So I think this is something that also we talk about in your educational videos about confirmational bias and really trying to use the information on the market profile to keep you focused on what actually is happening instead of what you think should be happening.
Sorry, guys. I always forget to turn on my mic for you guys. So yeah, there's several ways to look at this, right? There's sort of, were there warning signs ahead of time that the market was getting ready to roll over, that it was running out of steam? But to really what I think we should focus on is how you handle in the moment, like yesterday morning, when the market looked, like you said, it looked bullish for the first few minutes of the day. It looked like we were about to get a gap and go, and this thing was going to go straight to the moon. How do you go from handling that, both reading the market and trading the market, to then handling a sell-off and reading it and trading it? And so my take as a trader is always to just go with whatever the information is saying at that moment and then change your mind the minute the information changes. And it's really difficult to do, especially if you're first learning. But for me yesterday, the market did look bullish first thing in the morning. It looked like it was going to go higher. It looked like we were going to get a gap and go. I was bullish. There's nothing wrong with going long, for example, when the market fills the gap, because you think it's going to be a gap and go. It's giving you signals that it's bullish. But once the market filled the gap, it did not bring in buyers, right? It filled the gap, and then it immediately started to push down into the previous day's range. At that moment, you have to adjust. At that moment, you have to say to yourself, okay, it looked bullish. It looked like it was going to, gap and go. It looked like it was going straight to the moon, but now it doesn't look like that anymore. Now it looks like we're going to pull down into yesterday's range. So then you have to change what you're thinking. Now, I wouldn't have gone straight from bullish to bearish yesterday because of the mechanics that the market has had, right? Where it's been slowly creeping higher day after day. I'm more primed to think, okay, this will probably be a dip into yesterday's range. So as a trader, I'm going to stop out of a long trade. If I'm long for a gap and go, I'm going to accept that loss. I'm not going to worry about it. I'm going to go back to a neutral stance and say, okay, maybe it's just a little dip into yesterday's range, and I need to just wait to see if we buy that dip to look for another long, or do we get new selling? And then as soon as the market got to the C period, it was clear at that point that the market had momentum to the downside. So yeah, then you start looking for the short. And the way I approach trading in general is I trade what I'm seeing. And then as soon as I'm out of a trade, I don't worry about it anymore. I don't think about it, because that's what we talk about with confirmation bias. I just go, okay, great. I didn't make money on the long. Let me go make money on a short. And what ends up happening over time is the winning trades pay for the losing trades. It's okay to be wrong. It's okay to misread what the market is going to do and change your mind. What is not okay is getting fixed into an idea of thinking the market has to keep going up. And then, you just keep taking losing trades, or you miss out on taking winning trades after your first losing trade. So that's my thoughts.
Yeah. And I think that's a really good thing to talk about too, is now that the markets are so volatile, what is your advice on stops? Because in a volatile market like this, sometimes I know for myself, sometimes I have to think of a bit of a wider stop, because to prevent myself from getting stopped out. So how do you adjust your risk in these really volatile markets?
So the answer is I do a lot more work. So I don't go wider with my stops. I go the same with my stops. But if I get stopped out, I'd be ready to re-enter the trade. For me, it's easier to get in a trade with a tighter stop, get stopped out, re-enter the same trade again, rather than, have a wider stop. So like, for example, just looking at your chart here, they can see this. You won't be able to on the screen, but let's say, for example, I'm shorting down here in, I can't tell what time period that is. Looks like D. Yeah. There you go. Perfect. Yeah, just leave it right like that. That's great. E period low is actually what I was looking at. So let's say in the E period, I'm shorting, right? And I'm using a nice tight stop. Sorry, in the F period, I'm shorting and I'm using a nice tight stop above the E period high. The market comes up. I'm short. It stops me out. We get cessation of the trend, right? And then I'm like, well, fuck, I'm out of the trade. I just say to myself, what's the next trade? How do I get in again? Because as soon as I remember this from yesterday, the ticks were getting smacked down like a motherfucker. The market, the internals were crystal clear that this was just a bounce and that the market was not, the momentum hadn't shifted yet. So I could immediately look to get short again. Here, let me just switch to my chart. Sorry, everyone. The market's coming down. I'm shorting. We get cessation, right? I might get stopped out of that first trade because I'm using a tight stop, right? I could have used a wider stop. I could have said, let me put my stop above the base of the single prints down or whatever. But instead, I'd rather get stopped out, have the market start to build momentum again, and then get into a new short once again, once that momentum builds. So that's the way, nowadays, the most common thing for me as a trader is I enter trades As soon as I can, I move my stop, below my entry if it's a short, or above my entry if it's a long, maybe a point in profits, And then if I get stopped out, I just get in again. And if I get stopped out, I just get in again. And I just keep getting in trades because it'll do that. It'll chop and chop and chop, but eventually it makes the move. And so I want to be in the trade when the move happens. And there's two ways to do that. Like you said, looser stop to just let it chop and chop and chop, or get stopped out, re-enter, get stopped out, re-enter. And then whenever it makes the move, you're in the trade. So that's just a matter of taste.
On one thing, because I did find it a little bit confusing that so we stopped one time framing in the F period, but then the G period also stopped one time framing. However, it engulfed the F period. And one thing I've learned is that when you see that engulfing happen within the 30-minute market profile time frame, that is a sign of indecision. So I got a little bit concerned about that. However, when you look at the top of the G period and where it stopped and then totally reversed, it couldn't even get into the value area from yesterday. So to me, that was a clue. That's a good place to go short. Plus you had that high volume node around there too.
Yeah.
So it kind of got rejected out of yesterday's range.
That's another when
rejection.
Yeah, that's another when what should happen doesn't. It should have been able to fill those single prints, especially on the ES.
Exactly.
I was in 2-tick increments on the ES. Let me go to my 2-tick chart. Oh, we're getting there. Hold on. Okay. Yeah, I was in my 2-tick chart. And it came up and it backfilled those singles perfectly in the 2-tick chart. But on the 1-tick, it left behind like a couple of single prints. And so that to me was another thing. If the market was ready to reverse and head back up to the highs, they shouldn't have turned those single prints into resistance, right? They should have pushed right through it. So the resistance there was the idea, wait a second, this selling isn't over. And also, like I said, the market internals were crystal clear. That confirmation from the internals. But as far as handling the multiple cessations and all the confusion, that's just part of handling more volatile days, right? Like anyone who's been trading for the last month is used to the fact that sometimes the ranges are super tight and the market goes nowhere. And sometimes you get these big, huge ranges. And so on that day, in that moment, you just have to adjust and say, today is a tight range. Let me think about it in tight range terms. Today is a very wide, choppy range. I need to think about it in more volatile terms. And you just have to be on the fly with this market and just constantly be willing to change your opinion when you're wrong.
So what's your opinion about the overnight inventory right now? Because it's 100% long at the moment.
Yeah. So at the close yesterday, my thoughts were, as a swing trader, to be bearish, right? Because of the way that we pulled value lower. So if you look at yesterday's range, I'm looking at the ES, but I'm pretty sure it was the same thing on the NQ. If you're looking at yesterday's range, the market went from the high to the low. And when it got down to the low, it spent time and brought in volume down here at the low. We pulled the value area up against the low of the day. We brought in the most volume at the low of the day. We brought the POC, where we spent the most time, to the lows. Everything was down. And so to me, that tells me that we haven't brought in those stronger hand buyers yet, right? They haven't bought the dip. So anytime that we get cessation on a daily time frame, let me switch to the regular candlesticks because it's a little bit easier to point out there. This is momentum on a daily time frame. Anytime that momentum comes to an end, which is making lower highs on the daily, there's two questions that I'm asking myself. Is the market going to go sideways at higher prices as a way to balance off this momentum, or does it need a pullback with price? Does it need a dip to balance off this momentum? Well, the fact that we closed near the lows, we spent so much time, we brought in so much volume, tells me that the higher probability over the days ahead is that the market wants to go lower. But if you were watching the live stream yesterday, at the end of the day, the very last few minutes of the live stream, I said the only thing that would convince me I'm wrong is if the overnight inventory tonight were to push the market all the way back up and we opened in the upper end of yesterday's range. So seeing that that's exactly what happened tells me that today is likely to be a sideways day inside today's range. I am still bearish into next week for a pullback. This is just a very large gap that we left behind here. It's a very obvious target for the market. If I was a longer term, trader, or sorry, that's not the gap. The gap's down here. If I was a longer term trader who was looking to buy big dips, there's no reason why I would chase price at the high. I would wait for it to come back down, and I'd be looking to get inside this gap where there'll be a better opportunity. So to me right now, the overnight inventory is saying we're going to go sideways inside today's range. And I would say quite simplistically, it usually isn't this simple, but I would say quite simplistically, if we get below yesterday's low, look for a larger pullback on a swing basis. If they're going to balance with time, they need to stay above yesterday's low.
So the fact that we're opening so far above, would you consider that a spike down from yesterday then in the M&N period, or is not?
No, it's not technically a spike down, but it's kind of the same thing. It's a sign that there was still selling at the end of the day. Mm-hmm. The dip buyers didn't buy that dip. Because if they had, the market would have bounced by the end of the day. And so the fact that the market was still struggling to bring in buyers right into the close means there's buyers still out there who haven't entered yet. So, this overnight inventory could just be overnight traders hoping the market's going to bounce. And, we talked about this yesterday with Paul, is like the overnight inventory is very weak hands. They will change their mind instantly. So if the market opens this morning and just goes sideways in here, well, great. But if it starts to pull back, they could all get squeezed very quick and we're right back at the lows, So yeah, I would describe myself as completely neutral right now, especially until 10 a.m. when Powell starts to speak. Everybody's waiting with bated breath to see, is he going to say rate cuts? So yeah, I would say until 10 a.m., definitely nothing. After 10 a.m., the market will react to Powell. And if you put a gun in my head right now and made me guess what the market is going to be doing by, say, next Wednesday, I think we're going to have another dip. I think it needs a pullback to fill that old gap. Any other questions, Dee, or things you want to add before we say goodbye?
No, I think what we should look at the open is whether or not there's a counter auction to overnight inventory being 100% long. Just be careful not to get caught up. Sometimes the counter auction can be deceiving, because even though the market will originally correct that inventory, that doesn't necessarily mean it's completely bearish either. Sometimes the counter auction is just what the market needs to do before it picks its direction of the day. So
yeah, 100%. Especially because we're right dead center in the middle of yesterday's range.
Right.
You know what I mean? So that's a place where we could expect chop. It might look like it's selling off rapidly, and then it buys its way right back up rapidly. You know what I mean?
The other main thing to look for is, can we enter yesterday's value area? And do we find acceptance if it does enter it?
Yeah, and that's also getting into single prints from yesterday.
Right.
So if we get into those single prints, can we backfill them? What happens when we backfill them? Is it resistance there and it immediately sells right back off? Or do we backfill them and keep going?
Yeah, so this is a really exciting day. We have a lot of information to digest, especially with Powell speaking. There's going to be a lot of volatility, and just everyone be careful out there. And
yeah, my thought is be cautious. My thought is be very cautious. Don't force trades today. Wait until you fully understand what's happening, because like you say, things will probably reverse a lot today inside this range.
Right. Well, thanks, Charles.
Thank you very much. All right, guys, we'll see you on Tuesday. Bye-bye.
Bye.